There is only one side to the market that matters, and it is not yours. You may have an opinion, you may have an indicator, you may have a news story that sounds convincing, but the market does not move on opinions. It moves on supply and demand, always has, always will. When I was a young boy in the bucket shops, I thought I was trading numbers. I believed I was trading patterns. It took me years and several fortunes lost to understand that I was trading people. Their fear, their greed, their urgency, their hesitation. Supply and demand is nothing mystical. It is simply the measure of urgency. When buyers are more eager than sellers, price rises. When sellers are more desperate than buyers, price falls. That is the entire game. But knowing that in theory and trading it in practice are two different matters entirely. You see, demand does not announce itself politely. It does not send you a letter saying, "We are accumulating shares now." It reveals itself in footprints in the way price behaves when it should fall but does not. In the way, it rallies on heavy volume and retreats on light volume. In the way, bad news fails to push it lower. That is demand. Likewise, supply leaves evidence. When a stock rallies strongly but cannot advance further despite good news, when it breaks beneath support with force and no meaningful bounce follows, that is supply overpowering demand. The public is forever trying to predict. The professional waits to observe. I learned the hard way that anticipation is expensive, confirmation is cheaper. There were times I bought because I believed a stock was cheap. Cheap compared to what? My opinion? My imagination? The market does not reward what appears cheap. It rewards imbalance. If supply is still greater than demand, a cheap stock can become cheaper still. A trader must ask one question above all others. Who is under pressure? If sellers are under pressure, if they have already sold most of what they own, demand will lift prices with surprising speed. But if buyers are trapped, holding positions they regret, then rallies become opportunities for them to escape. That creates supply overhead. That creates ceilings. Most men lose money because they focus on price alone. They ignore position. They ignore psychology. Imagine a stock that has fallen for months. The public is wounded. Every rally reminds them of their losses. When price rises slightly, they sell grateful to recover something. Their selling becomes supply. That supply pushes price down again. That is not random. That is human nature. On the other hand, consider a stock that has advanced steadily. Those who bought early are sitting on profits. They are confident. Pullbacks do not frighten them. When price dips, others step in, fearful of missing the move. That is demand feeding on itself. The market is a study in emotional repetition. Now let us speak plainly about trading supply and demand in practical terms. First, never fight a clear imbalance. If demand is in control, higher highs, higher lows, strong closes, you have no business selling simply because the price feels high. High prices can go higher. I made my largest fortunes not by buying low, but by buying right. And right meant buying when demand proved itself. Likewise, do not buy simply because something has fallen. A falling market is one where supply dominates. Until that supply is absorbed, you are stepping in front of a train. How do you know when supply has been absorbed? Watch the reactions. If price declines on decreasing momentum, if it tests prior lows and refuses to break convincingly, if rallies begin to carry farther than declines, demand may be quietly returning. The market whispers before it shouts. Patience is required. Most traders cannot endure patience. They need action. They crave certainty. The market offers neither. In my early years, I would see what appeared to be demand, and I would commit too heavily, too quickly. When the market turned against me, I held on convinced I was correct. Pride is a costly companion. Risk management is not separate from supply and demand. It is born from it. If you buy because you believe demand is emerging and the market immediately shows increased supply, instead you are wrong. Exit. Do not argue. The tape is always right. The great secret is not predicting imbalance. It is responding to it. Let us speak of volume. Volume is the voice of participation. A rise on expanding volume suggests urgency buyers competing. A rise on shrinking volume suggests exhaustion. The same is true in reverse for declines. But volume alone is not enough. Context matters. A surge in volume at a prior resistance level may signal distribution, large interest selling into public enthusiasm, or it may signal breakout demand, overwhelming that supply. The difference lies in follow-through. Does price continue advancing after the surge? That is demand asserting dominance. Does it stall and reverse sharply? That is supply absorbing demand and then overpowering it. You must study behavior, not headlines. There was a time when I made millions during a great decline because I recognized that supply had become relentless. The public believed prices could not fall further. They were certain of recovery. Their certainty became supply. Every rally was sold. The imbalance persisted until panic exhausted sellers. But I will tell you this, recognizing demand at the bottom was far more difficult than recognizing supply at the top. Fear moves faster than optimism. Selling is urgent. Buying is cautious. That is why markets often fall swiftly and rise gradually. To trade supply and demand effectively, you must detach from hope and fear. You must observe where pressure lies. Ask yourself, are buyers chasing strength? Are sellers panicking into weakness? Are pullbacks shallow or severe? Do breakouts hold or fail? These are not academic questions, they are survival questions. And never forget position sizing. Even when demand appears overwhelming, you must allow for error. The market does not owe you continuation. Enter with conviction, yes, but also with discipline. Add to positions only when demand proves you correct. Reduce exposure when supply emerges. Do not average down into supply. That is stubbornness disguised as strategy. There were years when I thought I had mastered this game, only to be humbled by my own overconfidence. Success breeds carelessness. A trader must remain vigilant. The law of supply and demand does not bend for past victories. The greatest fortunes are made by aligning with persistent imbalance. The greatest losses are suffered by denying it. If demand is rising, be long. If supply is dominant, be short. If neither is clear, wait. Waiting is a position. Modern traders have more tools than I ever imagined. Charts that update instantly, data flowing from every corner of the globe. Yet the principles remain unchanged. Human emotion has not evolved as quickly as technology. Fear still accelerates selling. Greed still fuels buying. Impatience still ruins discipline. Supply and demand is the market's heartbeat. Listen to it. Do not try to control it. When you feel the urge to predict, step back. When you feel the need to act without confirmation, pause. When the imbalance is clear, act decisively and manage your risk without hesitation. In the end, the market is not conquered, it is interpreted. Those who learn to read, supply and demand, are not fortune tellers. They are observers of pressure. They do not argue with the tape. They do not marry opinions. They align with force. That is the entire business. You are not trading stocks. You are trading urgency. Understand where it lies, and you will find opportunity. Ignore it, and the market will extract tuition as it once did from me, repeatedly, until I learned that price is nothing more than the visible expression of an invisible struggle between supply and demand. Respect that struggle, and trade accordingly.